Hi, this is Jim Welsh from macrotides.com. Thanks for tuning in. Historically, a yield curve inversion has developed after the Federal Reserve has raised short-term interest rates significantly and the U.S. economy has begun to slow materially, causing long-term rates, 10-year and 30-year Treasury yields, to fall significantly. Last December, the Federal Reserve increased the federal funds rate to 2.4%, but since late October of last year, the yield on the 10-year Treasury yield has dropped from 3.25% to 2.08% on June 6th. So the reason the yield curve has inverted is not because the Fed has continued to raise interest rates, but because 10-year Treasury yields have fallen so much. So let's take a look to see if the current yield curve inversion holds as much bite as yield curve inversions have in the past. The first chart shows the 3-month Treasury yield versus the 10-year, and as we can see, it has inverted, in fact, prior to other recessions. As of June 6, it was negative by about 26 basis points. The bottom half of the first chart shows an estimation based on the 3-month and 10-year yield curve, an estimation of when a recession is likely, and it projects one for about 6 to 7 months from now. But I'm going to say not quite so fast. The leading economic indicator has done a better job of providing an advance warning than the yield curve of recessions coming. Historically, it has flashed a negative signal 10 months prior to recession versus 19 months for a yield curve going back to the 1950s. Given that we're in a pretty fluid situation, looking at a 6-month rate of change on the leading indicator seems important, especially since the LEI made a new all-time high in May. So if we look at the 6-month rate of change, we can see that it is still positive, and it shows, in my opinion, that the U.S. economy is in better shape than what the yield curve inversion is suggesting. So are there some factors that are driving the 10-year yield down? One of them is central bank policy in the ECB and Bank of Japan. And the net result is there are now almost $11 trillion of sovereign debt around the world that have a yield less than 0%. The spread between the U.S. 10-year Treasury and the German Bund is a minus 235 basis points. So clearly, in my opinion, Treasury yields have in fact been tugged down by what's going on globally in the global bond market. Positioning is also very important. Every single week, the Commitment of Traders report comes out and it shows what the large speculators are doing. Historically, the large speculators are trend followers. And if you notice, back in early 2017, as the bond market started to rally, in the middle panel, the green line showing this large speculators, they began to establish a bigger and bigger long position. After bond prices peaked in September of 2017 and then subsequently fell, large speculators reduced their long position and then wound up taking a very large position last October. That was one of the reasons why I thought bond yields were going to decline materially, because I thought large speculators were going to be forced to cover. And they did, going into February of this year. But as you can see, in March and April, large speculators, against their normal pattern, actually increased their short position even as bond prices were rallying. And I think they did so because they thought that a trade deal was going to occur and that would help the economy and so forth. So if we look at the spread between the 10 and 30-year Treasury, we can see that it has widened significantly over the last 10 months from 10 basis points to 50 basis points. The short position in the 30-year Treasury futures is far smaller than in the 10-year. So again, this supports the notion that part of the decline in 10-year Treasury yields has been driven by short covering by those who were short. My conclusion is the recession risk is not quite as high as the yield curve inversion suggests. And then one caveat, which has to remain there, is if President Trump decides to add tariffs on the remaining $300 billion of Chinese imports, and they then subsequently retaliate, that will change the picture. But based on what we're looking at today, the yield curve, I think, is giving a little bit more of a dire warning than is warranted. Thanks for tuning in.